Before we go any further, I need you to do something right now. Drop a comment and tell me where in the world you're watching this from. Country, city, I don't care. And if this is the first time you're on this channel, hit that like button before I say another single word. I need to know how many people are actually paying attention tonight, because what I am about to walk you through is not showing up on any mainstream financial network until Monday at the earliest. And even then, I guarantee you they are going to miss the point entirely. They are going to run headlines about volatility. They are going to call it a market event. They are going to interview analysts who tell you the system is working as designed. And they are going to completely miss why the warehouse is empty, who emptied it, and what happens next. It is Sunday night, February 1st, 2026. The markets have been closed all weekend. Nobody on Wall Street is picking up the phone. And in less than 12 hours, when the electronic sessions fire up and traders in Tokyo and Shanghai sit down at their screens on Monday morning, the silver market is about to crack wide open in a way that most people watching this have absolutely no idea is coming. I'm not saying that to sound dramatic. I'm not saying it to manufacture urgency or to sell you something at the end of this video. I have been tracking precious metals markets for years on this channel, and I have never, not one single time, seen delivery data like what just dropped out of the CME group. The numbers that came out today should not be possible. They should not exist within the framework of how this market has operated for decades. They violate every assumption that the future system has run on since its inception. And the fact that they do exist, the fact that we are sitting here on a Sunday night looking at documented, verifiable data that proves the Comex warehouse is effectively empty, means that something has fundamentally and permanently changed in the global silver market. Something that is not going to change back no matter how aggressively the paper market tries to pretend otherwise. The February 1st delivery data just dropped, and the numbers tell a story that is going to make a lot of very powerful people very uncomfortable very quickly. For the first time in the recorded history of the Comex, physical delivery demands exceeded registered inventory. Not by a rounding error, not by a small technical margin that could be smoothed out with a phone call or a paperwork adjustment, by a gap so massive, so structurally devastating, that the exchange literally cannot fulfill every single delivery request with real, physical, tangible metal. Contract holders demanded 65 million ounces of silver to be delivered from Comex vaults. The registered inventory, the silver actually sitting in approved depositories, ready to be physically moved, transferred, and handed over, stood at 38.2 million ounces, a shortfall of 26.8 million ounces that the exchange has no obvious way to fill. The warehouse is empty. And the reason it is empty traces back to one decision by one government that most Western analysts dismissed as political theater when it was first announced. On January 1st, 2026, China reclassified silver as a strategic national resource. They restricted exports to 44 state-approved companies. They sealed 60 to 70% of the world's refined silver supply behind government gatekeepers. And since that moment, silver has been flowing into China like water going down a drain. It goes in, nothing comes back out. The door only swings one way now. Western industrial users, the companies that manufacture solar panels, electric vehicles, semiconductors, AI data centers, the companies that need silver to build the products that power the modern global economy, they cannot get metal from China anymore. The supply line is severed, so they turn to the Comex. They exercise their legal right to demand physical delivery instead of rolling their contracts forward. And they found the shelves stripped bare. The registered inventory has collapsed by nearly 90% since its peak in 2020. And whatever remains is being fought over by JP Morgan, Citibank, Deutsche Bank, and every other institution that already saw what was coming. This is not a correction. This is not a volatile week that will blow over by Wednesday. This is not a temporary disruption that the market will absorb and recover from the way it has recovered from disruptions in the past. This is a structural breakdown of the global silver supply chain, a breakdown that has been building for months beneath the surface where retail investors never look. And the February 1st delivery report just made it impossible to deny, impossible to explain away, and impossible to ignore. Monday morning is when the rest of the world catches up to what the data has been telling us for weeks. I have said before on this channel that the silver market was headed for a moment of truth. That moment is here. It arrived today. And the question now is not whether the system is going to crack. The question is how badly, how fast, and who is going to be on the right side when it does. Subscribe if you are not already. Share this tonight. Tell someone. Because by the time Monday afternoon rolls around and the mainstream media starts running their version of this story, the move will already have happened. The people who understood what was going on tonight are the ones who are going to be positioned correctly when the dust settles. Now, let me take you into the numbers, because the numbers are what make this undeniable. February 1st delivery report. Total physical delivery demands across active silver contracts, approximately 65 million ounces. Those are not estimates or projections. Those are actual delivery notices issued by contract holders exercising their legal right to take possession of physical metal from Comex vaults. They rejected cash settlement. They rejected rolling their positions into the next contract month. They looked at the exchange and said, I want the bar. I want the silver. Give it to me. Not dollars, not paper, the metal. And they demanded 65 million ounces of it. In a normal month, a number like that would not trigger a single alarm bell anywhere in the precious metals industry. The Comex operates a network of approved depositories across the United States that exist for exactly this purpose. These are not ordinary warehouses. These are massive, heavily secured, climate-controlled facilities where silver bars are stored in registered inventory, tagged with individual serial numbers, tracked in real time, and available for immediate delivery. And the entire infrastructure was built to handle delivery demands without strain. It was built to be deep. It was built to be reliable. And for the better part of 2 decades, it was both of those things without exception. Back in January of 2020, registered inventories on the Comex sat at over 300 million ounces. That was the high watermark. That was the point of maximum depth and maximum credibility. If you held a futures contract in January 2020 and you exercised your right to take delivery, you would have received your bars without delay, without drama, without any noticeable strain on the system. 300 million ounces is an enormous cushion. It represents years of normal delivery activity. The exchange could have absorbed massive demand shocks and still had plenty of buffer left over. But according to data released by the CME Group, registered silver inventories as of late January 2026 stood at just 38.2 million ounces. Not 300 million, 38 million. That is a decline of approximately 88% from the peak. Nearly 9 out of every 10 ounces that used to sit in those vaults has been withdrawn, shipped out, transferred to private storage, or absorbed by buyers who have no intention of putting it back. And that decline did not happen smoothly or predictably. It accelerated violently in the second half of 2025. Word started spreading that China was about to restrict silver exports. Industrial buyers started panic buying physical metal to stockpile before the supply chain was disrupted. Institutional investors started converting their paper positions into physical metal to protect themselves, and the pace of withdrawal from Comex vaults went from a steady drip to a flood. So the math is simple. 65 million ounces demanded on February 1st. 38 million ounces available in registered inventory. A shortfall of 26.8 million ounces that the exchange cannot fill from its own warehouses. That might sound like a technical problem. An operational issue that can be fixed with enough creativity and enough phone calls. But it is not. It is a fundamental challenge to the credibility of the entire futures market. Because when you purchase a Comex silver futures contract, the entire value proposition rests on one core assumption: that physical delivery is a real and exercisable option. That is what separates it from a pure financial derivative. A Comex futures contract is supposed to be anchored to real, physical, tangible metal sitting in a vault. If you want that metal, you can have it. That is the promise. That is the bedrock. But if the metal is not there, if the vault is empty, the contract becomes something else entirely. It becomes a promise the exchange cannot keep. And when an exchange makes promises it cannot keep, when the physical backing disappears, the price that exchange sets loses its meaning. It becomes a number on a screen that no longer represents anything real. Now you're probably thinking about eligible inventory, silver that meets Comex standards but has not been formally registered for delivery. It is sitting in the same vaults. It exists. And technically, it can be converted to registered status if the owner authorizes it. According to estimates, total Comex holdings combining registered and eligible come to roughly 113 million ounces. That is enough on paper to cover the shortfall. But here's the wall you hit when you try to use eligible inventory as the solution. Eligible inventory is privately owned. Every ounce belongs to someone specific, and that someone has not given permission for their metal to be delivered against futures contracts held by strangers. In a normal market, when prices spike, the incentive to convert becomes overwhelming. You could sell at a premium. That is how the system self-corrects. That is the pressure valve that has kept the futures market functional. But the pressure valve is not releasing. The owners are not converting. They are holding. They see the inventory collapse. They see the China export ban. They see the structural deficit building. And they have made a calculated decision that selling now, even at a premium, is leaving money on the table. They believe this metal is going significantly higher. Some of them are industrial users who need it for their own production, and some are almost certainly institutions like JP Morgan, which, according to industry estimates, holds approximately 750 million ounces of physical silver and has absolutely zero motivation to sell at current prices. The eligible inventory is locked behind the decisions of private owners who can see exactly what is unfolding. The registered inventory is exhausted, and the Comex is facing the worst delivery crisis in its modern history with no obvious path to resolution. The The February 1st shortfall is just the beginning. The February contract remains open for the rest of the month. More holders can demand delivery on any trading day that remains. Each new delivery notice pulls more metal out of registered inventory. Each withdrawal makes the buffer smaller, and then on February 27th, the March contract hits its first notice day. That is the date everyone in this market is watching with genuine anxiety. Because the March contract carries open interest that dwarfs available registered inventory by orders of magnitude. We are talking about potential delivery demands in the hundreds of millions of ounces against a registered base of 38 million ounces and shrinking daily. If even 10% of March contract holders stand for delivery, the system breaks, not bends, breaks entirely. The Comex runs out of metal. And at that point, the exchange faces two choices. Neither is good. Choice 1. Declare force majeure. Admit it cannot deliver physical metal. Settle everything in cash. That destroys the credibility of the exchange overnight. The paper price becomes meaningless, and the physical market, already trading at massive premiums in Asia, becomes the only market that matters. Choice 2. Let the spot price rise to whatever level is necessary to incentivize eligible inventory owners to convert and sell. $200, $300, $500 or higher. That bankrupts every short seller on the exchange. It triggers margin calls across the entire future system. Institutions fail. It is systemic chaos. The question is not whether one of these outcomes materializes. Based on current trajectories, it is looking increasingly difficult to avoid. The question is, which happens first and who is positioned to survive it? To understand how we got here, we need to talk about the single most consequential event in the global silver supply chain over the past year. We need to talk about what China did on January 1st, because that is where this crisis was born. On January 1st, 2026, China implemented the most aggressive precious metals export controls in modern history. They reclassified silver as a strategic national resource. That reclassification triggered a completely different regulatory framework. Different licensing, different oversight, different approval processes. Under the new rules, only 44 state-approved companies were granted permission to export silver. When this was announced months before it took effect, the reaction from Western analysts was dismissive. China restricts some exports. Markets adjust. Other suppliers fill the gap. The world keeps turning. That was the consensus. The consensus was catastrophically wrong, because the assumption treated China as one producer among many, as if restricting Chinese silver exports was comparable to restricting exports from any other nation. It was not comparable at all, because China is not one producer among many. China is the silver market. Chinese refineries process between 60 and 70% of all refined silver produced on this planet, not 60 to 70% of what China mines domestically, 60 to 70% of everything. Silver from Mexico, Peru, Chile, Australia. It all flows to China for refining, because Chinese facilities are the cheapest, fastest, and most technologically advanced on Earth. Over 2 decades, the entire global refining infrastructure consolidated inside Chinese borders. And on January 1st, China locked the gates. Those 44 licensed companies can export roughly 121 million ounces per year. That sounds meaningful until you compare it to what used to flow freely. Before the restrictions, China was shipping 250 to 300 million ounces per year to global markets. The new cap cuts that in half. And even the reduced volume requires case-by-case government approval on every shipment. The licensing thresholds were designed to be deliberately restrictive. To qualify, a company must demonstrate annual production capacity of at least 80 metric tons. That is roughly 2.5 million ounces per year. That single requirement eliminates every small and mid-sized refiner from participating in international trade. Their metal stays inside China. It goes to domestic buyers who are paying premiums of $8 to $15 per ounce above Comex spot prices just to secure physical delivery. But the export controls are only half the story. The other half is even more revealing about what China is actually doing here. They are not just blocking silver from leaving, they are actively pulling it in. State-owned enterprises and strategic resource funds have been buying physical silver on a massive scale since mid-2025. They are stockpiling. They are treating silver the same way they treated rare earth elements a decade ago, as a strategic asset that must be controlled, secured, and hoarded. And the numbers confirm it is working. Silver inventories on Chinese exchanges have actually been falling despite the export ban. If China was just keeping domestic production inside its borders, inventories should be rising. But they are falling, which means domestic consumption exceeds domestic production plus imports. China is consuming more silver than it produces. The gap is being filled by draining global markets, by draining Comex, by draining LBMA, by pulling metal out of Western vaults and shipping it east until there is nothing left to pull. Now let us talk about the physical premium explosion. Because what is happening in Asian markets right now has no precedent in modern commodity market history. and it is the clearest preview of what Western markets are about to experience starting Monday morning. On January 1st, the same day China's export ban went into effect, a massive price divergence appeared across global silver markets. The Comex futures market in New York was quoting silver at approximately $72 per ounce. That was the spot price. That was what Bloomberg showed. That was what every financial website reported as the official price of silver. But in Japan, physical bullion dealers were selling silver at $130 per ounce. Not 72, 130. That is an 80% premium over the Comex screen. In Dubai, 120 to 130. In South Korea, premiums of $7 to $12 per ounce. In India, $5 over spot. Even in Europe, which normally tracks Comex closely, spreads widened to $3 to $6. An 80% decoupling between paper and physical prices sustained across an entire region of the globe. This has never happened before. Not in gold during any crisis, not during the Hunt brothers squeeze, not at any point in the recorded history of organized precious metals trading. This is new territory. The market is telling you that two fundamentally different things are now being called by the same name. In a functioning market, this gap would last minutes. Arbitrageurs would buy at 72 in New York, take delivery, ship to Tokyo, sell at 130, and close the spread. That is how interconnected markets are supposed to work. That is the self-correcting mechanism that has kept global commodity prices consistent. But the arbitrage is not happening. The gap is not closing. It is widening. And there are three structural reasons why. First, delivery from Comex is no longer fast. Wait times have stretched from days to weeks. Vaults are backlogged. The metal you receive may not match what Asian buyers need. Comex delivers 1,000-ounce bars. Asian retail demand is for 1-ounce coins. Converting formats requires additional refining that kills the arbitrage margin. Second, shipping silver internationally has become dramatically more expensive. Insurance costs spiked. Security requirements intensified. Customs delays lengthened. Freight costs rose. By the time you stack all those costs on top of the purchase price, the profit has evaporated. Third, and this is the fundamental reason, physical sellers do not want to sell into the Comex price. If you can move metal locally at 130 while the paper price shows 72, you hold. You wait. You believe the paper price is artificial. You believe it is going to catch up to physical reality eventually, so you hold. And every seller who holds makes the gap wider, makes the premium stickier, makes the physical market more disconnected from the paper market. The physical premium is not a glitch. It is not a temporary anomaly. It is the market revealing what silver is actually worth when real buyers compete for real metal, without the distortion of paper contracts, backed by empty vaults. Now, here is why Monday matters. Up until now, this premium explosion has been an Asian phenomenon. Western investors have been watching from a comfortable distance, assuming the Comex price will hold, assuming Asian premiums are a regional problem that will sort itself out. But they are wrong. The February 1st delivery data just proved that Comex is running out of metal. When Western traders fully understand that, when they realize physical delivery from the exchange is becoming impossible, they are going to do exactly what Asian buyers already did. They are going to pay whatever it takes to secure physical metal. And that is when the premiums arrive in Western markets. Imagine walking into a US coin shop on Monday afternoon and being told that silver eagles are selling at 125, when the spot price on your phone shows 90. You would think it is a scam, but it is not. It is the same reality Asian buyers have been living with for a month. And it is coming to the West. This week. Maybe today. When it does, the media will call it a shortage. But it is not a shortage. It is the collapse of the paper pricing mechanism and recognition that physical silver is worth far more than any Comex screen has been suggesting. Now we need to talk about JP Morgan. Because while retail investors are scrambling, while industrial users are panic buying metal they cannot source, while China is absorbing every ounce the global market can provide, there's one institution that has been quietly positioning itself for exactly this moment for over a decade. One institution that saw this breakdown developing long before it became visible to anyone else. And one institution whose actions tell a story that mainstream financial media has consistently refused to examine. According to the first delivery report of 2026 from the CME Group, JP Morgan's house account stood for massive physical delivery on the January silver futures contract. Over 1,000 contracts in a single reporting period. Each contract represents 5,000 ounces. That is 5 million ounces of silver that JP Morgan demanded be physically delivered from Comex vaults into their possession. Not cash settled, not rolled forward, moved, transferred from the warehouse into JP Morgan's allocated storage as real bars. Standing for delivery at that scale is not routine. It is not something you do casually. When a major institution takes 5 million ounces of physical silver in a single period, it is making a statement. It is saying, we do not trust the paper market to represent value. We want the physical asset. We want it in our hands where nobody can touch it, dilute it, or cash settle it against our will. JP Morgan has been making that statement repeatedly. According to analysts who track Comex delivery data, the bank has been accumulating physical silver since at least 2012. Some estimates place their total holdings at 750 million ounces. That is more than a full year of global mine production, the largest private silver stockpile in recorded history, bigger than the Hunt brothers, bigger than any sovereign wealth fund, bigger than any central bank. They built that position while the price was being suppressed. While silver traded at $14, $16, $18, $20 through the middle of the last decade, while retail investors had given up on precious metals, while the narrative was that silver was dead. While everyone else was selling or shorting, JP Morgan was taking delivery, quietly, consistently, month after month for over a decade. And here is where the story becomes deeply uncomfortable. JP Morgan was fined $920 million by the Department of Justice in 2020 for manipulating precious metals futures markets. They admitted to spoofing. They admitted to placing fake orders designed to move prices in directions that benefited their own proprietary trading desks. They admitted to doing it for years. It was the largest criminal penalty ever imposed for precious metals manipulation in United States history. Lay the timeline flat. JP Morgan manipulates the silver market for years, suppressing the price. While the price is being held down by their own manipulation, they accumulate the largest physical stockpile in history at those artificially depressed prices. They get caught. They pay the fine. They continue accumulating. And now, with the Comex facing a delivery crisis, with physical premiums at 80% in Asia, with China having locked down 60 to 70% of global refined supply, JP Morgan is sitting on a position worth roughly $75 billion, accumulated at $14, $16, $18 per ounce, while they themselves suppress the price. That is not investing. That is using market manipulation to transfer wealth from retail participants into institutional hands at artificially low prices, and then profiting enormously when the manipulation ends and the price adjusts to reflect actual supply and demand. Now in January 2026, they are still at it, still standing for delivery, still pulling metal out of the system, because they can see exactly where this is headed. They see the inventory crisis, they see the China export ban, they see the March contract demands building, and they know that when the Comex runs out of metal and force majeure becomes unavoidable, the institutions holding physical silver will be the only ones left standing. The paper holders will be cash settled at whatever price the exchange decides. The physical holders will own an asset trading at 130 in Tokyo and potentially 200 or more in Western markets when the premium explosion arrives. JP Morgan did not stumble into this position. They engineered it. They saw this coming years ago. They positioned themselves on the winning side. And Monday morning, when the market fully processes what the February 1st data reveals, the questions about how they knew are going to become impossible to avoid. So here is where we stand. It is Sunday evening, February 1st. The markets have been closed all weekend. The February 1st delivery report has dropped. The numbers show a shortfall of 26.8 million ounces. China's export ban has been active for 31 days. Physical premiums in Asia are at 80% above paper prices. JP Morgan is still taking delivery. Eligible inventory owners are holding. And in less than 12 hours, when Asian markets open on Monday morning, the silver market is going to move in ways that most participants are not prepared for. The question is not what is happening. The question is what you do about it. If you are holding physical silver, the answer is straightforward, even though it will not feel straightforward when the volatility hits. You hold, you do not sell, you do not let the headlines scare you out of a position that is about to become significantly more valuable. Your instinct, when you see chaos, is going to tell you to sell, to lock in gains, to protect yourself. That instinct is wrong. If the two-tier market between paper and physical becomes permanent, and the data strongly suggests it will, the physical silver you are holding is going to be worth far more than any Comex price suggests. Every ounce you sell into the paper price is an ounce you're handing to someone who understands what that metal is actually worth. If you are holding paper silver, SLV shares, futures contracts, you need to make a serious decision before Monday opens. Are you comfortable holding a position that could be cash settled at $80 or $90 while physical silver trades at $130 or higher? If the answer is no, you know what to do. Convert, sell the paper, buy physical. Yes, you will pay a premium. That premium is not a markup. That premium is the actual cost of silver in a market where physical metal is genuinely scarce. If you are thinking about buying for the first time, understand what you are walking into. Supply is constrained. Demand is accelerating. The gap between paper and physical is widening every day. The exchange that is supposed to anchor the price to reality is running out of metal. That environment creates opportunity. It also creates volatility. Dealer spreads are wide. This is not a trade. This is a structural position that requires patience. Watch the data tonight. Watch Comex registered inventories. If they drop below 20 million, force majeure becomes inevitable. Watch delivery demands on the remaining February contracts. Watch how dealers behave Sunday night and Monday morning. If more go no bid, prices are moving significantly higher. Share this. Subscribe. Tell people what is happening. Because the mainstream media will not explain this story accurately when markets open Monday. They will call it volatility. They will put analysts on camera who tell you everything is fine. They are wrong. Trust the data. Trust the delivery reports. Trust the inventory numbers. Those are the only signals that matter right now. So here we are, Sunday evening, February 1st. The delivery data is out. The shortfall is documented. The crisis is real. And in less than 12 hours, when Asian markets open on Monday morning, the silver market is going to move. The world is about to wake up to what happened today. That delivery demands exceeded registered inventory for the first time in Comex history. That China has systematically drained global silver supply. That the warehouse is empty. That JP Morgan is still taking delivery while everyone else runs out of metal to deliver. And that the March contract, hitting first notice day on February 27th, could be the moment when the entire paper pricing system breaks down. I do not know what the price will do when Monday opens. I cannot predict whether it gaps up or down. I cannot tell you if the Comex intervenes with emergency margin hikes. I cannot tell you if dealers go completely no bid or just widen spreads. But I can tell you this, the data is real. The inventory collapse is real. The China export ban is real. The crisis is real. When the mainstream media catches up on Monday, when analysts start running the numbers and realizing the Comex is on the edge of force majeure, the panic is going to intensify. Subscribe, share this tonight. Because the greatest commodity squeeze of the 21st century is not coming. It is already here. China took the silver. The Comex is empty. And Monday morning, the rest of the world starts to figure out what that means.